Okay, exercise 1019. The company is preparing their December 31st, 2020 year end. We're given some balances in the accounts, and then we're given some additional information. And we're asked to prepare any required adjusting entries as of the end of that year. So we go back to A. $10,800 of income tax was accrued monthly from January through November inclusive and paid on the 15th day of the following month. The actual amount of tax expense for the year is determined to be $126.40. So each month they did an entry for $10,800. So they would have debited income tax expense, credited income tax payable, and then on the 15th they would have paid that amount. So they would have did a debit to income tax payable and a credit to cash. Now, the last month, because remember how we said with income tax, they determine or they estimate what they're going to pay for the year. They divide it by 12 and pay it each month. And then in the last month, they kind of balance it out to the correct amount. So in the last month, it ended up being $126,040 that they're owing. So they did $10,800 for 11 months, which is $118,800, and we can see here that is the income tax expense. So we know that's correct because that's what would have been recorded as an expense up to this point. The actual amount is $126.40, so we subtract what's already been recorded. So this month we don't have to record the whole $10,800. We only have to do the difference here to bring it up to the correct amount. So we would still do a debit to income tax expense and a credit to income tax payable because it won't get paid till the 15th of the month of the next month. So we're still recording a payable, but we're not recording that same amount. Okay, hopefully that was clear as mud. B. A customer is suing the company. Legal advisors believe it is probable that the company will have to pay damages, the amount of which will approximate $140,000 given similar cases in the industry. So here, it is probable that they will have to pay, and they are able to estimate an amount, so therefore we're going to record it. The account names here, this is not necessarily 100% what they would be called, but we need to come up with something. So we would need to record some kind of loss, so legal loss, as a debit, $140,000, and then we would need to record some sort of liability. So a credit of $140,000 to legal liability. C. During December, Mackenzie had sales of $710,000. 5% of sales typically require warranty work, equal to 20% of the sales amount. So now we know we need to record a warranty expense and a warranty liability. The amount, $710,000. 5% of sales typically require warranty work. So 5% of that sales amount, so $35,500. And the amount is equal to 20% of the sales amount. So $35,500 times 20%, so we get $7,100. So we debit our warranty expense, $7,100, and we credit estimated warranty liability. Again, we're recording our expense in the same period that the sales happened to comply with the matching principle. And we're recording a liability, an estimated liability for the future because we're anticipating having to complete this warranty work. D. Mortgage payments are made on the first day of each month. So go up here, we see a mortgage payable, 5%, $440,000. So $440,000 times 5%, and it's for 1 month out of the year, so 1 divided by 12 gives us $1,833.33 as interest. So we record that interest in the month, interest expense, as a debit, and we credit the interest payable account. Because they're going to get made on the payment's going to get made on the first day of the month. So we're going to record the expense right now in the correct month in December. We're going to record a payable, and then January 1st, they're going to turn around and they're going to debit the payable, interest payable, and they're going to credit the cash account because they're going to make that payment. They're going to pay off that interest payable, so they're going to get rid of the payable amount, and we're going to reduce our cash. E, 111,500 of the unearned revenue remains unearned at the end of the year. So currently unearned revenues are $296. So only this amount remains unearned, so that means the rest of it, the difference between those two amounts, has been earned during that year. So 296 minus the 111.5 is 184.5. So we have to remove that from unearned revenue. So we're going to debit, and we're going to record it now as revenue for this year. So here it's fee revenue. And in F, the 120-day note payable was dated November 15th, 2020. So if we go back up here, we can see the note payable was for $80,000. So it was issued on the, November 15th. So it's not going to get paid until the following year because it's 120 days. But we do have to record the interest. So 80,000, 4%, and then we calculate the number of days it was outstanding in 2020, which was 46. So that was the portion of the year that it was outstanding, 46 out of the 365 days. So we do the math on that, and we get 403.29. So we record the interest expense that year of 403.29, and we record the liability. We have an interest payable of 403.29. Part B, determine the adjusted amounts for profits, for liabilities and profits. They give you a starting amount. So basically, I'm not going to go through it. You just take your starting amount and then you go through each of these entries and you add or subtract accordingly. Alrighty.